Welcome to this week's Market Update, where we review what shaped markets, highlight what drove performance, and look ahead to the week's key events. First, the US Treasury will keep its regular bond auction steady, leaning on short-term bills to cover rising financing needs. For investors, that steady supply should keep yields on high-quality bonds attractive. With the Federal Reserve weighing inflation against a slowing economy, this is exactly where owning a diversified mix of quality bonds pays off, giving portfolios dependable income and a stabilizing anchor. Next, the job market. Job openings eased to 7.36 million in June, down from 7.54 million. While hiring picked up and layoffs stayed relatively low, employers are becoming more selective rather than pulling back sharply, adjusting to higher interest rates. This cooling in labor demand gives the Federal Reserve the justification it needs to consider lowering interest rates in September, a move that tends to benefit both stocks and bonds. And finally, Apple significantly expanded its manufacturing in India, part of a multi-year effort to build more products outside of China. This reflects a broad trend that we're watching, that being large companies are spreading out operations to make supply chains more resilient and reduce geopolitical risk. For long-term investors like us, this creates fresh opportunities across technology, industrials, and emerging markets. And Alphabet, the parent company of Google, gained just under 7.3% as the market is rewarding real results from its AI investments. Its Google Cloud business is growing on AI demand and new AI features which are now built into search and its workplace tools. Investors like the disciplined spending and improving profitability. With leadership across search, cloud, and advertising, a strong balance sheet, and a reasonable valuation, Alphabet has multiple ways to turn AI revenue, which is why we own it. Information technology was our leading sector, and the strength was broad. Microsoft and NVIDIA led, with Broadcom and ASML also contributing. The story is simple: strong earnings, steady cloud demand, and heavy investment in AI infrastructure. These companies have sturdy balance sheets, recurring cash flows, and long-term growth trends. With valuations elevated and returns increasingly concentrated among a few leaders, we focus on the established, cash-generating businesses best positioned as companies everywhere adapt AI. Our size strategy, which tilts towards large, well-established companies, was our strongest performer. Giants like NVIDIA, Amazon, Alphabet, and Caterpillar all delivered impressive gains. Investors keep favoring these companies for their durable earnings, strong cash generation, and the firepower to keep investing no matter the economy. That scale is especially valuable in uncertain times, and it's the kind of quality leadership we want anchoring our portfolios. Wednesday delivers the headline event of the week ahead, the Consumer Price Index, which measures how quickly everyday prices are rising. The most recent reading showed inflation easing to 3.5% over the past year, and that was down from 4.2% the month before. It matters because inflation sits at the center of the Fed's rate decisions, and a continued slowdown would support both stocks and bonds. Thursday brings the Producer Price Index, which tracks prices businesses pay before those costs reach store shelves. Think of it as an early preview of consumer inflation, coming right after Wednesday's report. It helps complete the inflation picture that the Fed is studying as it weighs the next move. Friday closes the week with July retail sales, a direct read on how much Americans are spending. The most recent reading showed spending up a modest 0.2% in June and about 6.7% higher than a year ago, a picture of a relatively resilient consumer. Because spending drives roughly 2/3 of the economy, this is one of the clearest signals of momentum, and it supports the quality, consumer-facing companies that we favor. As always, we remain focused on helping you reach your long-term financial goals through disciplined investing. Thank you for joining us, and we'll see you on the next update.